Hello everyone, welcome back to our YouTube channel. We are PGN Accounting Group. Today's video is called Where to Save Your Money. But before we get into the video, please hit the subscribe button, follow us on Instagram. It really means a lot to us. We do these for free. We don't ask for you guys to pitch in or buy this subscription model to get access to our material. No, we want to make this content free for everybody so that you guys could benefit from it and really implement it into your lives, because we care. And we hope that you guys support us by subscribing to our YouTube channel and following us on Instagram. It really means a lot. Also, if you want to book an appointment with us or your free initial consultation, go to pgnaccounting.com and book that appointment today. Back to the video, where to save your money. First, before we get into this video, if you haven't already, go check out our How to Win Financially video, because we're going to be kind of piggybacking off of that. That really has some base knowledge that it would be beneficial for you to know before you watch this video. So if you haven't already, go check that out. But if you have, then right back into the video of where to save your money. First, it's a no-brainer. You should have a checking account. This is where when you're working, everything gets deposited in there for direct deposit. This is where all your transactions are coming to and from. With people pay you outside of your work, outside of your direct deposit, that's going to come into this account. And also all of your bills, your utilities, your rent, your credit card bills that you're going to pay for, it's coming from this account. Maybe a minimum amount in this, probably of $1,000. The reason for that is you don't want your checking account to balloon up to tens of thousands of dollars, because it's just sitting there. It's not accumulating interest. It's not growing. It's not invested. Unless you're about to make a large purchase or pay off a large credit card payment or something like that, then you should not have a lot of money in your checking account. And if you're budgeting every single month, like we're teaching you in our previous videos, then you should know about how much money it takes to maintain a minimum amount in this checking account. Now, you don't want to always get really close to zero, because then you risk getting negative and overdrawing your account, because then you get overdraft fees, and the banks like to charge so many fees for that. So we want to avoid that as much as possible. I hate paying fees. I hate paying interest. So I do not want you guys to do that. And usually we could avoid that by establishing about $1,000 minimum balance in your checking account. Now, if you go to 800 or 700, that's fine. Just let it get back up to 1,000 and try to maintain that. Number 2 is please open up a high yield savings account. What this is it's a regular savings account, but it's in addition to your checking account. Now, you're not going to use this for your direct deposit, which you might if you want to do a second direct deposit from your work, where the majority of your direct deposit is going into your checking and maybe $500 or $1,000 is going into your high yield savings account. That's fine. But there should not be a high volume of transactions going to and from your high yield savings account, because this is usually for your emergency fund, which, like we talked in our previous video, covers your deductibles. Some examples of a high yield savings account are Capital One Savings, which is about 3.4% interest rate. Ally Bank, which is paying about 3.6 to 3.8, depending on if it's a savings account or a money market. Marcus by Goldman Sachs is paying about 3.75%, and Synchrony is paying 4%. So, as I said, checking accounts and savings accounts with these big banks like JP Morgan Chase or Wells Fargo or Bank of America, they're paying a measly 0.01 or 0.02% on your money. So they are not paying you to keep your money in their bank. So don't keep it there. If you want to keep maybe a little bit, because it's very easy to access, because that's where your checking account is, that's fine. You know, these are not rules that you must abide by. I like making money if my money is just sitting there. So I like to get about 4% on my emergency fund that is not being touched and it's just sitting there, that needs to be readily available. And while I'm not using it, I'd like to earn a little bit of money on it. And if it's going to pay 4%, then I'm going to take it versus 0.01%. So it's kind of a no-brainer for me. And again, this is for your emergency fund. This is not for money that's coming in and out regularly. You should not be drawing on this account regularly per month, and you should not be putting into it regularly per month once you have your emergency fund established. Now, if you're building up a fund for a car that you want to purchase or a down payment for a home that you want to purchase that you don't feel comfortable investing that into the stock market because maybe it's going to be a purchase that you're going to make in 6 months to a year, then by all means, put it in a high yield savings account because then you get to earn a little bit of money. So that's totally fine if you want to put and contribute into the high yield savings account regularly, but you should not be taking out regularly from this account. Number 3 of where to save your money, it's an employer 401k or a Roth 401k. Now, I recommend the Roth 401k because it's after-tax dollars. So unfortunately, you're not going to get the deduction at the beginning, so you can save taxes, but the growth is going to be tax-free. And when you take out the money in retirement, it's going to be tax-free. So I much rather not have a deduction now, but not have to pay tax on hopefully millions of dollars of retirement when you retire at 67. You could take after 59 and a half, I understand, but usually the retirement age is 67. So I'd rather not pay taxes when I actually have to withdraw from the retirement account. I recommend that you contribute to this Roth 401k up to your employer match. So if your employer is only matching dollar for dollar up to 3%, put in 3%. But if they're going to match 10%, put in 10%. So up to the employer match, then that is what you should contribute to your employer 401k or Roth 401k. The reason behind that is because it's 100% return on your money. It's free money, and you're not going to get 100% return on your money anywhere. And that's immediately. So we really recommend this after you establish your checking account and your high yield savings account. Contributing to your 401k up to the employer match is next on the priority list. Now, after you've done that, then after you've contributed up to the employer match, sometimes that's 3% or 5% or 10%, you still want to contribute more up to that 15-20% into your retirement, because if you're only doing 3-5% into retirement, that's not going to be enough by the time you're 67. Yeah, it's going to be a nice sum, but it's not going to be enough for you to be at peace and to be comfortable in retirement. If that up to the employer match doesn't reach up to that about 15%, then you should contribute the remaining portion into your Roth IRA. So for example, if you're, let's say, at 5% contributing to your 401k, because that's what the match is, and then maybe you're contributing the extra 10% in your Roth IRA so that you could get to that cumulative 15% of retirement contributions. Now, again, you could do your traditional IRA or your Roth IRA. But again, Roth IRA is preferred because it's after-tax dollars. So this is an additional retirement vehicle. And again, Roth IRA is better because you don't have to pay tax on it when you retire. And you can do this not only for the working spouse, so the person that actually has a W-2 job or is self-employed and having earned income. So if you have a stay-at-home husband or a stay-at-home wife, more commonly, then that person is not out of luck of retirement contributions. As long as one spouse is working and earning earned income, then the non-working spouse can contribute to a Roth IRA. That way you could double up your Roth IRA contributions for the year and hopefully reach that 15% of retirement contributions every single year. Some places that you can open a Roth IRA are Fidelity, Vanguard, and Charles Schwab. I'm not sponsored by any of them, but I do recommend Fidelity. It's very easy to use. I love the interface. You could do fractional share buying, so you don't have to buy a full share, which is great. And they have a lot of different varieties that you could buy stocks, you could buy bonds, you could buy ETFs, mutual funds. There's so much variety that you could purchase in your Roth IRA. It's amazing. So you have these options. You have more options in addition to these, but I recommend Fidelity. Now, the health savings account. If you've been watching a lot of my videos, I preach health savings account all the time. HSA. Open one. If you have a high deductible plan, open one right away and contribute the maximum that you can to it. Yes, you can only use the money that you put in there for medical expenses, but when you look at the qualified medical expenses you can reimburse yourself with your own money from an HSA, you'll realize that you have a lot more opportunities to take that money out than you thought from the beginning. Also, if you're healthy, great. Then that means you don't really need it. But it's a great retirement savings vehicle because you put away $3,800 or $7,600 every single month, every single year until you hit 67. Eventually, when you have kids, you get married, or you get older, you're going to have medical bills. So it's nice to build up this HSA so that you could use that for your medical expenses. And also, this is also not commonly known, but you can invest the money in your HSA into mutual funds, into ETFs. So it's not just relied on your contributions to grow, but it's going to grow with the investments that you're putting it in. So if it's put into a mutual fund that's following the S&P 500, it's going to double up every 7 years because it's earning 10% rate of return every single year. So imagine if you've been maxing out your HSA for 30 years, you're going to have hundreds of thousands of dollars, maybe even close to $1 million. If you've been contributing enough for a long enough period of time, then you could really have a substantial nest egg in your HSA when you retire. And again, some examples of where you can open one up are Fidelity, Optum Bank, and Further by Health Equity. Optum Bank is a very popular one. Health Equity is another very popular one. If you have it through your employer, you must have a high deductible savings plan, which means your premiums are lower, but your deductible is higher. So you're going to have to pay a little bit more out of pocket when you do see a doctor, but hopefully the savings on your premiums you're putting into the HSA, and it'll more than cover any out-of-pocket deductibles that you have to pay. After you've exhausted all of the other vehicles, retirement, HSA, high-yield savings account, and you have additional savings that you don't know what to do with, where to put it, you can put in a taxable brokerage account, and you could buy stocks, ETFs, index funds, mutual funds, bonds, whatever that brokerage account lets you invest in. Then you can use that additional savings into this brokerage account. Now, I don't recommend that you open this up right away. If you haven't already saved up your emergency fund and put in a high yield savings account, if you are saving for a home and saving for that down payment, then I don't recommend that you put much money into this because you need that money right away. So park it into a high yield savings account and let it grow 3 to 4% every single year while you're saving up for that down payment or saving up for that new car. And if you are not contributing enough into your 401k to get the employer match, then don't even worry about the taxable brokerage account, because you kind of have to hit those steps before you graduate to putting money into your taxable brokerage account. But let's say you finally reach this point and you're able to do this. Then some examples of where you can open one up are Fidelity, Vanguard, E-Trade, Interactive Brokers, JP Morgan Wealth Management. There's some other ones like Robinhood, and I'm not really advocating that one, but there's a bunch out there. You could always find one. But I like Fidelity because it offers a wide variety of investments. Again, Not sponsored by them, but they're a great platform to open up all of these retirement HSA and taxable brokerage accounts. And that's it for where to put your money, where to save your money. Again, if you haven't watched my other video of how to win financially, please watch that, because it's going to make all of these a lot more sense when you watch this video. Thank you for tuning in all the way to the end. We try to benefit you guys and really help you guys grow financially. We hope that you really learned a lot from this. And if you have, then please hit the subscribe button, follow us on Instagram, share it with your friends. And if you want to book an appointment with us, go to pgnaccounting.com. If not, then we'll see you guys on the next video. Thank you and take care.